Welcome and thanks for joining us. Really looking forward to this session with Ben Claremon, who works with value investing veteran Jeff Bronchick at Cove Street Capital based in Los Angeles. Of course, Ben Claremon will be familiar to most of you as the inoculated investor, his namesake value blog, and one of the few must-read blogs out there. Ben joined Cove Street in 2011 after previous experience at other investment firms, including West Coast Asset Management, which will be familiar to many of you. Ben also has an impressive academic background, getting his undergraduate degree from the Wharton School and his MBA from UCLA's Anderson School of Management. Today, Ben will share with us his favorite small cap idea, a name that is down about 50% over the last couple of years and down more than 70% since 2007. We always love to hear about beaten down stocks, so this should be a great session. And with that, Ben, the floor is yours.
Thank you. I just want to thank John and Oliver for giving me this opportunity. I'm looking forward to sharing my thoughts on Ruby Tuesday with everybody. The title of this presentation is Turnaround Pieces in Place, and I'm going to give you my thoughts on Ruby Tuesday and why I think it's a compelling investment opportunity right now. But first off, I'm just going to spend a couple minutes very briefly introducing Cove Street Capital. I think it's important to understand what we look for and how we look at value, and you kind of understand better how we came across Ruby Tuesday. So Cove Street Capital, SEC registered firm, founded in 2011 by Jeff Bronchick, who is our Chief Investment Officer. We employ a concentrated value strategy. Small cap value is our core strategy. Business value people, that is really, as we look at every single stock in our portfolio, that is the analysis that we run for everything. What kind of people are you investing with? What's the value? And what's the quality of the business? We have a small team here. There are 3 of us on the investment management side. Jeff Bronchick's the CIO, my colleague Eugene Robin, and then myself. As Oliver mentioned, I was the inoculated investor. That site is no longer operational due to SEC compliance issues with having an outside blog. But these days I spend more of my time looking for undervalued securities than anything else. And I refer you to our website. There's a lot of interesting stuff, a lot of stuff written by Jeff Bronchick at covestreetcapital.com. Quickly on our investment philosophy, it's just a bottom-up, research-driven process. We concentrate on our best ideas, 30 to 35 stock portfolio in small cap. We think and act long-term. We try to take a 3 to 5 year time horizon on all the stocks in our portfolio. We're not traders. We try to ignore kind of schizophrenic volatile markets. We like compounders, like long-term, kind of Warren Buffett stocks that you can buy and you just hold on to them, and you know that every year they're going to compound. And less is more. I think that is the big difference here. Fewer analysts, less trading, fewer stocks, just more concentrated. We have a 4-step investment process. Starts with idea generation. We screen for both good and cheap businesses. We have a lot of management meetings coming through here. In fact, that's how we came across Ruby Tuesday. There was their management team came through here in, I think, late 2011. And then, Jeff Bronchick's got almost 30 years of investment experience, and so, he has a database of companies that we have access to in his mind. So next step is our data download. We have a proprietary spreadsheet that we use. We kind of populates a bunch of Capital IQ data. We screen for Buffett stocks, which are great businesses trading at reasonable prices. We also screen for Graham stocks, which are cheap stocks that have a large margin of safety embedded. We're not intellectual purists. We don't say that we only invest in one or the other. We take what the market gives us. We take the cards that the market deals with, and we try to find cheap stocks. The next step is a unique kind of process here at Cove Street. It's a team tackle and deep dive. all three of us take a look and do deep research on every name. This is not a thing where the portfolio manager kind of just takes analyst recommendations and makes the decision. We all team tackle the stocks. We have 2 long and 1 short. There's a short analyst on every stock, and that person does his best, basically, to come up with why we shouldn't buy the stock. We try to triangulate value. We use DCF, sum of the parts, multiples, earnings power value. We're not tied or wedded to one valuation structure. We just, we try to say if a stock is cheap based on these 3 metrics, you have a better chance of being right and having a margin of safety. We look for good businesses that have sustainable competitive advantages. But given the world we live in today, we also we don't ignore the macro completely. And so Jeff has created what's called a PEST analysis: political, economic, social, and technological risk. Just things that are not necessarily some things that you have to think outside of the financial statements to find. And then portfolio consideration: full positions, a 5% position, half positions, 2.5%. All right, so that's our background. And if you want to look at learn more about us, you can go to coastreetcapital.com. So I'll move on to Ruby Tuesday. Ruby Tuesday was founded in 1920. It's based in Tennessee. The main concept, they have a number of concepts, and I'll talk about that, but the main concept and the driver for value is going to be the Ruby Tuesday concept. They have 790 stores in 45 states. They also operate in 11 foreign countries. But you're not going to hear me talk much about the international operations. It's really immaterial in terms of the value of the company, what's going to drive value. It's mostly company-owned now, as franchisees have closed stores, and Ruby Tuesday has actually bought back stores from franchisees that were underperforming. And so, as you'll see, we'll talk mostly about the Ruby concept. The other concepts are Line Fresh, which is I'll talk more about, but it's small now, but it's a potential growth vehicle. And then the other 3 concepts, Wok Hey, Truffles, and Marlin and Ray's, are either being sold or closed because the management team really wants to focus on Ruby Tuesday, and I think we agree with that probably being the best course of action. So just some stats on Ruby Tuesday. Stocks trading around $750 today, 450 million market cap. If you look at the stock chart on the right, it's had everything in the world bounce from 2009, but the stock has really languished since then. We look at adjusted debt EBITDA, which is basically if you capitalize the leases and then divide by EBITDA, and including debt, about 3.6 times, which we think is a little high, but we're hoping that they'll use free cash flow to pay that down over time. The number of unencumbered owned stores, this will be an important concept going forward. They have close to 300 stores that they own outright. Stock's trading around 7.5 times what we call I would say trough, hopefully trough EBITDA right now. And they do have a large buyback authorization in place, almost 13 million shares, and right now, based on the basic shares outstanding, that's about 21% of the float that they could buy back. Moving on to the next slide, what has happened to this stock? The stock was $33 in March of 2006. You can see the large plunge that the stock has had in the stock chart on the right. And as I mentioned, it's just languaged post-2009. And I think it can all be boiled down to the inability to generate traffic and the inability to generate positive same-store sales. So if you look at this figure, this chart that has same-store sales, it may be a little bit of a crude way to think about it, but I think it illustrates the problems they've had. So if you had $1 in same-store sales in 2006, assuming the store that was in the comp base from 2006 to 2012, that store, if you just compounded the same-store sales, would have gone from $1 to 78 cents. And that is unique in the space. I've done a lot of work on the comps, 10 to 12 different comps, and no one is still that depressed, from their 2006 same-store sales numbers. So again, it's a little bit of a crude way of looking at it, but I think it's very illustrative of the issues that Ruby Tuesday's had. And as a result, average unit volumes per store have fallen from over 2 million to to about 1.8 million today. And of course, in that situation, you're going to see margins coming way down. And you can see EBITDA margins have gone from close to 20% in 2007 to less than 12 at the end of fiscal year 2012. And so you have basically negative same-store sales comps, and you've got margin deleverage, and operating deleverage that leads to margin deterioration. And as a result, Ruby has been doing a lot of things in the portfolio in terms of closing stores and trying to rationalize the store base. And so that's where we were. That's the past. And so what now? And this is kind of just an outline of the slides that I'm going to talk more in depth about. So I'm not going to spend a lot of time here, but these are the things that are going on now that I'm going to highlight going forward. So next slide is new leadership. And so this was an important thing for us. If you notice, one of our pillars is people in the business value people framework. And so leadership is really important. And so we got much more interested after following this stock, after we saw that the founder, Sandy Bell, had retired as chairman and CEO. Sandy was a good builder of a brand and a concept, and maybe on the operations and execution side was not so strong. And so we did not feel like he was a guy to turn around Ruby Tuesday. And so a guy named J.J. Bootkin was hired in November. He was a chief marketing officer at Darden, ticker DRI, which is a very large restaurant company. He's got 20 years of experience, and he came in and he pulled what you would almost call a kitchen sink kind of quarter. They announced that they were closing 29 Rubies. They were closing the other concepts that weren't really material. They're even closing 2 of their newly opened Lime Fresh stores that they realized they had made a bad real estate decision on. And they're going to take some impairments. The cash impairments are low, but they're going to take some impairments. So JJ came in, did a quick review, and said, this is the way forward. We're going to focus on Ruby. It is the only way we're going to drive value for our shareholders. And what we like is that JJ is his compensation is largely tied to the stock price, and you can see that he's got 250,000 options at cliff vest if the stock goes to 14 from 750 today. And then in addition to that, they've also hired a new CFO, a guy that we like, and we think that he complements JJ in a good way. So they've come up with some preliminary goals. I mean, our thought is basically, I mean, the opportunity that's listed here is kind of just my interpretation of what their opportunity is, and that's if you generate same-store sales, it's positive same-store sales. It's going to help improve operating margins, and then it's going to, on a store level, and then drive company operating leverage and reverse all of the deleverage that the company had experienced over the last 5 years. And so the management has come up with some, I would say reasonable goals. It's yet to be determined how achievable these are, but I think these are, relatively achievable. 3 to 5% revenue growth, 50 to 60 million in free cash flow. We don't see these goals as outrageous, and we think they're on the right path to achieving them. And so from my perspective, I'm really focused on margins. It's just the way that I approach a business when I'm determining the quality of a business. And in this case, when you're comparing Ruby to other concepts, you have to use EBITDA margins. The reason is that there's a difference in owned versus rented real estate, and so you kind of have to add back the rent component to try to get a sense, try to make these companies comparable. And in addition, you also have to realize that there could be differences in franchise versus company-owned stores within these companies. The more franchise it is, the higher margin that is, because that's more of a kind of a royalty business. And so, that's just something to think about going forward, because I'm going to talk in EBITDA terms. And so what overall, what has happened to margins at Ruby Tuesday, I've gone back and kind of read through their old filings, and basically they had a spike in payroll and restaurant operating costs that they've never recovered from. And when you've had negative same-store sales basically for 5 years, except for one small tick up, you're not going to be in any position to increase your margins. So if you go through the comps here, we start with Ruby Tuesday. You see the EBITDA margin drop that I talked about. And then I try to find a number of companies that have similar franchise bases, where a minimal franchising. And if you look at Darden, which is a bigger company, but just kind of directionally, you see Darden has much higher EBITDA margins. Moving on to the next slide, Cracker Barrel, which is, I would say, not what you would call, an incredible operator. From what I understand, they're even out earning Ruby Tuesday, and then P.F. Chang, which is kind of a higher price concept, but still, pre-buyout, they were before that company got buyout, they were, earning much higher EBITDA margins than where Ruby Tuesday is right now. So there is no perfect comp, but I think the general statement you can make is that it is clear that Ruby Tuesday is under-earning relative to its peers. And without any question, its margins and basically are below its cost of capital. And that's, you never want to be in that situation. And we think there's an opportunity for them to turn that around. Another thing we really like about this company on the corporate governance side is that there's an activist shareholder involved. The group is Becker Drapkin Management. We are friendly with this group. That's not the reason we got in the stock, but it just happened to be that Jeff Bronchick was familiar with these guys. They own about 5% of the shares. Matt Drapkin is now the non-executive chairman of the board, and you see that they've been exerting their influence over the process. His compensation package, the new CEO, which is based on stock price to some extent, aligns shareholders with the company. Capital allocation, as you'll see going forward, as I go forward in my slides, there's an opportunity to monetize the real estate, which they have started to do, and also they've been buying back shares very aggressively, which we think that Becker Drapkin has kind of been involved in all of these capital allocation decisions that I think were positive for shareholders. And then just to throw away for Berkshire Hathaway friends, Kevin Clayton from Berkshire's Clayton Homes division is also on the board. And so what is their strategy? And so how are they going to drive same-store sales? Because we've kind of identified what their issue is: negative same-store sales comps, big problem. And so their strategy, and JJ, as he's come in, has basically affirmed this strategy, is that they're moving away from couponing to TV advertising. They believe that couponing was creating a lot of low-value, kind of non-loyal customers that were used to only coming in when they got a coupon. And so as you can see from the slides, they're going to be reducing their coupon spend a lot, significantly, and moving towards national TV advertising, which is a risky strategy, but I'm going to explain on the next slide why I think there's a possibility that this could work. And the question is, why is it risky, and why did they move away from TV advertising originally? It's because they are constantly being outspent by Chili's and Applebee's and Olive Garden. These are companies that have much larger advertising budgets, and they were just getting really hit, and they didn't think their message was getting through. But as evidenced in JJ's comments about couponing, is that they're not going to completely move away from it, but they just don't think that it was creating the value that they need, and it wasn't creating the kind of customers they want. And so they're moving to national TV advertising. And as we turn to the next slide, the reason why I think this has a potential to work is that there's a large disconnect between the way that the current customers rate the store, the Ruby concept, and the amount of traffic they generate, right? So my thesis is that clearly they're having traffic issues as same-store sales have continued to decline, basically. But when they take surveys of their customers, they get very, very high reviews, and they've been increasing and improving. And so if my thesis is if they have the opportunity to get that message out, that look, this is not kind of a low quality concept that has that the food's no good and the service is no good. If they can just tell the story about what their current customers believe, I think there's an opportunity for them to start to drive same-store sales. So that's kind of what's going on with the Ruby concept. Another thing we like, the optionality from the Lime Fresh acquisition. So after having a flirtation with Lime Fresh and licensing some of the concepts for some stores, they decided to purchase the company outright. They did that in the early 2012. Lime Fresh is a Mexican chain with restaurants mostly in Florida. They have a couple in Alabama and along the Mid-Atlantic region of the East Coast. As I've mentioned, it's a small concept now, but they believe this is their growth vehicle. The management team believes that Mexican food QSRs do have positive secular growth trends behind them. And so they're going to open 10 or 12 this year, and their goal is to open 20 plus every year after. And as you can look as you can see on that chart on the side, these opening a store here has very, opening Lime Fresh has very positive cash-on-cash returns. Returns on invested capital are good. New store capex, these are mostly inline. These aren't freestanding. So only $750,000 in capex is not really that much. So this is not the reason we own the stock. But we like that there is a growth concept behind, in addition to the potential Ruby turnaround. The next slide discusses the real estate assets. And so one of my main concerns, starting off with before we really dug deep and decided to invest in Ruby, was that the store base was antiquated, and they were going to have a huge capex cycle coming in the next few years. But as we spoke to the management team and we went back into their filings, we saw that they had done a large remodel basically to the entire store base that was completed in fiscal year 2008. They spent $57 million just in fiscal year 2008. And I asked J.J. Bootkin right out on the last time we spoke to him whether or not he expects that the store base is going to have to be reset. He said absolutely not. That the remodel they had done would last a number more years, and they weren't expecting to really just throw all their capital into building the store base. And so with maintenance capex around $20 million and not building Ruby stores really because they need to fix what's going on the operations before they start building stores. This company has the ability to generate a lot of free cash flow. And the other cash flow generator that we really like is the value of the real estate. And so Ruby has, as I mentioned, 290 owned unencumbered stores. And they have been monetizing them, maybe not at the rate that we would like, but they have started to monetize them. And the average value they've received on a sale leaseback has been about $2.3 million. And so if you take that average and apply it to the 290 stores, you're getting $560 million in real estate value versus the $490 million market cap. And so even if, maybe that average is a little high, maybe they're kind of cherry picking their best stores, but even if that average goes down to $2 million, you're still coming up with really nice, real estate value, given the market cap. And so we think that provides a margin of safety. And what they've been doing is they've been using the proceeds from this monetization of the real estate to buy back shares at what we think is at a discounted price. And the management team has said that they are committed to continuing this, and they're looking to monetize an additional 20 stores over the next next 6 quarters. We're hoping that they'll pick up the pace a little bit when it comes to that. So valuation, how do we value Ruby? Turnarounds are always very difficult to value. It's, you tell me what the margins are going to be in 3 or 4 years, and I can tell you, what the stock's going to be worth. And handicapping and predicting that margin ramp is very, very difficult. And so what we're trying to do is trying to be conservative in our minds and say, let's say that Ruby gets to X margins by 2015 or 2016. That's their fiscal year, 2015 and 2016. What does the stock look like on a DCF or a price to earnings multiple basis? And that's kind of how we've done it. There's no exact way when a turnaround. This is not just a compounder where you can just plug in, 8% EPS growth for the next 10 years, unabated. You kind of have to look at what a fair, with a reasonable margin and a fair multiple, what is this thing worth? So let's just start with the fact that, intrinsic value is going to depend heavily on what their margin assumptions are and how much they can improve the operation. And I mentioned here that if Ruby Tuesday can get even back to just 2010 EBITDA margins, which are 15.3%, versus 11, or 11.8, 11.6 in fiscal year 2012, there's a lot of upside in the stock. And so being cautious of the turnaround, right, and being very cognizant that turnarounds are never linear and they're never particularly easy, we try to be conservative. And so on our DCF, if we're assuming that with limited growth, if they can get back to 10% EBITDA margins by fiscal year 2016, that gets the price around $9.50 with the stock around $7.50 today. What that says to me, that a return to mediocrity, I mean, right now they're well below mediocre, but just a return to mediocrity and an operating margin and an EBITDA margin somewhere near where the comps are. You get a price at $9.50 from $7.50 today. If that happened, we would clearly not be thrilled with only a 25% return over that period. But we still think that that's just our conservative estimate. If they can get to 12% EBITDA margins by by that same 2016 period, you've got to double from here. And even that 12%, it would be, I think, low as compared to where some of the comps are. On a multiples analysis, kind of a similar thing. Assuming 10% EBITDA margins by fiscal year 2016, a reduced share count, and a 15.7 multiple, which is at a discount, 15% discount to the comps I've looked at. This gets you to a price around $9.25. Again, nothing to write home about, but we think that that's just on a return to mediocrity. If they're slightly better than mediocrity and they can get to 12% EBITDA margins, you're getting a price of 13. My Jeff Bronchick always he kind of scolds me because I'm very conservative in nature. I don't like to assume that a company is going to be able to turn itself around, and so I'm not the guy who's going to come up here and tell you this is going to be a triple, even if I thought it was possible. We like things where there's very little downside. A return to mediocrity is good upside, and then something a little bit better than mediocrity is a lot of upside. If we see a situation like that, I think we get pretty excited. And just another couple of things, as I've mentioned, there's the real estate assets provide, I think, a decent amount of downside protection as they can continue to monetize those assets and potentially buy back a lot of shares. And they also have a $158 million NOL that they'll be able to use to limit taxes going forward. Next slide, the short thesis. I mean, we always are considering what can go wrong. Why would someone, what is the bear case? And we spend a lot of time trying to flesh this out. And with Ruby, it's kind of simple. They're moving from couponing to TV advertising, and honestly, that strategy could fail miserably. Nothing is going to change about the competitive environment. Chili's and Applebee's and IHOP will continue to outspend them on advertising, and there is a potential for their message to get completely lost as they don't have the scale and they don't have the size to engage in a lot of national advertising. So I think that's a big risk there. Lime, the management team is relatively bullish on Lime, but there are any number of competing Mexican QSR chains out there. I mean, Chipotle is an incredible company, and you're always competing with them. And even if even if they can start growing Lime by 20 stores per year, is that even going to move the needle? And my guess is that this is just optionality. This is just the first thing they have to do is fix Ruby Tuesday concept, and then if Lime is beneficial, then that's just gravy. And so, but the focus on Lime could distract them potentially from Ruby Tuesday operation. There's still moving on to the next one, is that there's still a risk that JJ's only been there for a few months, and so he hasn't come in and said that everything that the prior guys were doing were wrong and we got to change all this stuff. He hasn't really said that, but there's always there's that first 100 days that a new CEO spends there, and it's possible that he may come to the conclusion as he spends more time that everything that they believed, there's a bigger reset here coming that maybe that people weren't anticipating prior, and so that's the farther they push off their improvement targets, the more difficult it becomes to justify buying the stock at the current level. The next thing is that Ruby is just an old concept. It's old and tired. The store base is not particularly vibrant. They have an older clientele who may be loyal, but very difficult to generate traffic among young people. And if they're not going to generate same-store sales, positive same-store sales, you're not going to see the margin improvement. And so they need to revitalize the concept. And I think that's through messaging to some extent. But it's possible, as I mentioned, that their message just gets lost in all of the advertising that goes on in this space. And then there's one thing the last thing that I think we all have to be very cognizant of is that prior margins were very different. We're achieved in a very different consumer and housing environment, but they're also with a different mix of franchises and company-owned stores. As they move more towards the company-owned model, it's possible that the prior margins will never be achieved, and that's so you can't anchor or benchmark against those margins necessarily and just say that, oh well, they earned a 19%, they're almost 20% EBITDA margin in 2007, they're going to get back there. We're not counting on that, but there's a possibility that the current margins are what they are going to be. So that's basically our thesis. I think it comes down, in conclusion, I think it comes down to little downside right now with a number of potential positives. You've got the sale leasebacks and share buybacks. You've got kind of an experienced management team in place. I'm not trying to throw Sandy Bell under the bus, who was the founder, but we just don't feel like he was the right guy to execute the turnaround. And JJ, whose specialty was marketing at Darden, I think it's a positive thing that a guy who can come in and really get their advertising and couponing mix right and hopefully drive same-store sales. We like things that are really beaten down, and the margins are as low as they've ever been. And so, as I've been said over and over again, just a return to mediocrity gets you a higher stock price here. Lime Fresh, it's just a free option, basically. I think if they can succeed in Lime, it'll just help just buffer everything that's going on at Ruby Tuesday. And right now the stock doesn't look to, if you look at the stock price, if you look at what the analysts are thinking about margins and earnings and things like that, the stock seems to be discounting almost no margin improvement in perpetuity. And we believe in some kind of reversion to the mean. Maybe the mean margin's a little lower than it was, but we just don't think that the current margins are sustainable at these low levels. And two Jeff Bronchick quotes. What if something good happens? I mean, very low expectations. Stock not discounting anything positive. Anything good happens. You're going to start to see people get more enthusiastic about the company. And we really like things where the downside appears to be boredom. If your upside in a scenario is maybe a double from 750 to 15, if they can get to 12% EBITDA margins, and your downside seems that limited, and we like the asymmetry of that. And then on the people side, we have Becker and Drafkin watching capital allocation and spending and doing, enticing them to do very shareholder-friendly things. And, we think the combination of all of that leads to a situation, again, a little bit of limited downside, potential upside, and anything, anything can happen. With that, I'll pass it back to Oliver.
Well, Ben, thank you so much for these comments on Ruby Tuesday. I'd like to refer anybody in the audience with questions for Ben to visit our online conference area where you can post a question, and I'm sure Ben will be happy to provide answers to you. Ben, I have a few questions myself. I'm wondering if you can, and we have a global audience here, if you could perhaps describe a bit more, the stores themselves, the concept, the kind of who goes there, and is the store base concentrated in any particular area of the U.S.?
Okay, so let's start with who goes there. Generally, it is I would say an older crowd, kind of older individuals and families. They were the bar. They did have a kind of a bar and grill feel similar to Applebee's or Chili's, with the things on the wall, or TGI Fridays with like kind of trinkets on the wall, and they moved away from that. That bar and grill is kind of a a younger kind of a demographic attends those, and they wanted to move away from that, and so they have their claim to fame, as it were, is a salad bar. So there's a salad bar that it's self-serve, which is, I think, unique in the space, and they think it attracts people, but it's more of I think that attracts more of a families and older crowd. They also offer free bread, which is another thing that they tout. Not sure. I'm not sure who that attracts, but I think it all goes towards more of a family atmosphere. The average check is somewhere between $12 and $13. The stores are about 5,000 square feet, kind of a clean, not particularly ornate kind of decoration. It's just kind of it's meant to feel welcoming, but it's not. There's nothing that stands out about it in any real way. I would say that they're being based in Tennessee, they're kind of concentrated more on the East Coast and Midwest. I mean, there are very few in California. So I would say that they're not so well penetrated all over the country, but I also say that it's not growing the Ruby concept is not part of their strategy right now. They're focused on fixing the operations. So to maybe to give you a sense of, I'm kind of anticipating what you were asking, but this is not we don't see a growth opportunity here for the Ruby concept.
Well, I guess what I did notice, and you mentioned it, the net check at about $13. I guess you made the point that in management strategy certainly to drive footfall. So do you consider this? It seems a bit low to me. This kind of net check figure. Is that a reasonable figure, and does it really just come down to more footfall, or has this average check also declined over the years?
I would say that they try to play in the value space, and what you're seeing is they don't really have the ability. I mean, they can potentially move the check a little bit up, but I mean, they don't have the ability in a constrained, kind of constrained consumer environment to raise prices very much, and then they have just been hammered by Applebee's 2 for $20 and Chili's 2 for eat for 2 for $30. Those kind of things have been really damaging in terms of the inability for them to raise prices, because the bar and grill guys have really started to try to get that value consumer as well. So I don't have the data in front of me what average check used to be years ago, but we're not looking for them to be able to raise that very much. And to answer your question, it's really about just getting people into the stores. It's, this is not a, they would love to increase their alcohol consumption a little bit within the stores because alcohol is higher margin and it leads to a higher check. And so that's something that you can do. But I would say that right now they're looking for, very simply, telling the story that this is good food, there's a salad bar, you get free bread, it's good value for your family, it's good value for young people, and the customers give it very high ratings. If you tell that story and you induce trial and you get people off of this dependency on coupons, we think that they can drive same-store sales. And just to be honest with you, I mean, my model does not have anything resembling high same-store sales comps. I basically have them continuing to lose, continuing to deteriorate on a sales per square foot basis the next few years before stabilizing. So we're not building in anywhere near the kind of top-line growth that the management thinks they can achieve.
It seems quite interesting, given this value orientation, that their performance would be so poor during the economic downturn in the U.S. I guess assumed that customers would gravitate more towards them as opposed to leaving them if they're positioned so in the value space. So is that perhaps to management's point about it's just about getting the message across to people who are not hearing the message?
Yeah, I think there's a number of things. I think, as I mentioned, you have the bar and grill guys going after that value customer very aggressively with huge national advertising spending, and I think that has had an impact. I think the general trend that we've seen as consumers have been very strained. Families are eating out a little bit less, and I don't think that the Ruby experience was special enough that if you weren't reminded of it, if you didn't see it on TV and maybe you didn't get a coupon, it wasn't special enough for you to come back in. But they've done, I think, a good job in terms of improving the food, improving the quality of the service, and so now I think they have a story to tell. And again, it goes back to this disconnect that I was talking about between the traffic and the scores. I think they do have a story to tell. And I think with the value concept and consumers continuing to be strained, I think just getting their message out there will be incrementally positive for them.
And on that message, getting the message across, you explained the coupon strategy and now the TV advertising strategy. What about, it seems a lot of these restaurant concepts do have opportunities in the online world with, whether it's the Facebooks or maybe some dating sites, or to just create some excitement and bring people into the store through some of these social media channels. Has that been mentioned by management at all?
Trying to think. My first kind of initial response to that is that every company that we follow has, on the consumer space, has some kind of digital email strategy, right? Where you have a Facebook page, or you get customer information, you email them all the time. I have not gotten a sense that is a big part of what they are trying to do. It's not that it's not important, but I don't think that that has been their focus. But yeah, I mean, if you want to get a younger, more kind of connected social group into the restaurants, then you're going to have to try new things. And so we will see with JJ being a marketing guy, whether they move more into that, and as I said, that's this kind of strategy, what you're talking about, is much more suited for JJ to handle than Sandy Bell, I would say. And so we think that if there is an opportunity here, JJ is the kind of guy who will be able to drive incremental traffic through some kind of digital email strategy.
And then also, I guess when I asked the question about the store base across the US, I meant more in terms of what I find interesting with these types of businesses is, you look at the average sales per store or the margins on a company basis, but often there is a huge discrepancy among the stores, and I'm wondering whether you have any insights, or does the management even disclose any metrics that could give you some more insight into, is there a trouble area somewhere, and there are actually 100, 200 stores that are doing just great, and is there an opportunity perhaps to do some further restructuring and get margins up that way?
So I can't answer that whether or not every quarter is different. The weather's great one quarter in one region, the stores do well, and the weather's terrible in another region, and the stores do terribly. So I don't think there's a systemic thing where the West Coast stores are doing poorly and the East Coast stores are doing well. I don't think that's the case. What is the case is that they have too many stores. I don't know what JJ's plan is, but I've spoken to their treasurer and their SVP of finance any number of times, and he thinks that the number of Ruby stores is going to continue to decline. So there's certainly portfolio trimming that will go on, both potentially on the franchisee side and on the company-owned side. So I think every concept has A, B, C, and D stores, right? And the goal is to get rid of as many Ds, turn Cs to Bs and Bs to As. And I think that's what they are in the middle of a portfolio kind of shift. And I think you can see that by the fact that JJ came in and said, you know what, we're immediately closing 29 Ruby stores. He hasn't said what the reason for that, but my guess is they had rankings, and those were the Ds. And he said, you know what, we cannot, these D stores, they cannibalize other stores, and they drag down the company margin. Let's take the hit up front, let's rationalize the store base, and let's accelerate the process of kind of undoing what I believe was a severe overbuilding with prior management. And I think if there's one thing that we have some, we have some criticism for Sandy Bell, the founder, on this, was that they just grew too much too fast, and I don't think their real estate selection was quite as good as it could have been. And then when you combine that with the fact that there was a downturn, it really made a lot of the stores, not get the kind of returns that you would expect as a shareholder.
Great. And then just lastly, I'm curious, you did mention the free cash flow figure, I think, of about 50 to 60 million, and that's assuming a turnaround. Is that right?
That's their number. I'm not modeling quite as much as that. I'm in the, maybe in a few years they get up to 60 as they, as the margins improve. But yeah, somewhere in the 40 to 60 range, they should be able to generate that. I don't see any reason why, in an improving scenario, why they can't generate somewhere in that range.
And so Ben, if we take that 50 to 60 million dollars of free cash flow that management has as its stated goal, once the turnaround is progressed, how does today's performance compare relative to those figures?
Well, I would say that, that is right in line with what I have them generating. Assuming that there aren't large changes in net working capital, which I know I have no ability to model. If I just kind of assume that working capital is a negative every year as they build working capital, just to be conservative, I see them over the next 4 years being right in that 50 to 60 million range, and I've got them assuming the number of Lime stores they're going to build on and the amount of capex they're going to spend. I've got them generating around 54 million this year.
Great. Well, Ben, we'll have to leave it at that. Thank you again so much for your time and all the insights on Ruby Tuesday.
Well, thank you. I really appreciate it, and look forward to doing one of these again. Thanks a lot.